right now, one out of every two Bitcoins in existence is currently being held at a loss.
Yeah, it's a pretty staggering metric when you really look at it.
It really is. I mean, half the market is literally underwater right now, just bleeding capital and stressed beyond measure. Yet, get this, if you pull up the Fear and Greed Index this morning, it just spiked to 80.
Wow, 80.
Yeah, 80. That is the zone of extreme euphoric greed. So, welcome to Bitcoin Deep Dives by MyCryptoParadise. Today, we are answering one underlying question. How on earth is half the market losing money while everyone acts like we are rocketing straight to the moon?
It's just a profound psychological disconnect, honestly. You have millions of retail traders sitting on this structural, agonizing financial pain, but it's completely papered over by this frenzied, surface-level optimism.
Right, it's like a facade.
Exactly. And as part of the Paradise family, the ethos of MyCryptoParadise is to, strip away that noise. We protect capital and we protect mindset. And to do that, we rely on hard data, not the hype.
Which brings us perfectly to the core of today's deep dive. We're looking at the latest internal market analysis from Simon, the head trader over at the Paradise team.
Always a good read.
Oh, absolutely. So our mission today is to dissect the mechanics of the professional trading mindset versus the gambling mindset. We're going to look at the behavioral biases that, mathematically speaking, guarantee most people will lose money over a long enough timeline.
Yeah, the stuff no one wants to admit.
Right. But most urgently, we need to explore Simon's data, because his analysis suggests the market is structurally gearing up for a massive crash down to the $44,000 level.
Yeah, and to understand why a drop to $44,000 is not just possible, but potentially necessary, we really have to look at the environment that's creating all this current euphoria.
Because human behavioral bias doesn't just happen in a vacuum, right?
Exactly. It requires a trigger. And for the average retail trader, there is literally no bigger trigger than the 24-hour geopolitical news cycle.
Okay, let's unpack this trigger then, because we literally just watched it happen in real time. The primary reason the Fear and Greed Index shot up to 80 was a direct reaction to a major geopolitical headline.
Right, the ceasefire news.
Yep. Former President Trump announced a ceasefire agreement with Iran, and immediately the market algorithms and retail traders saw the word ceasefire, assumed global stability was returning, and the index just ripped into extreme greed.
But impartially speaking, if you look strictly at the facts on the ground and just remove any political lens entirely, the reaction was deeply flawed.
How so?
Well, Simon analyzed the actual parameters of those ceasefire demands, and they are incredibly volatile.
Yeah.
For instance, Iran explicitly stated they have no intention of halting their atomic bomb infrastructure.
Oh, wow, really?
Yeah, so the underlying tension hasn't been resolved in the slightest. It's merely been paused under these heavily disputed, super fragile terms.
Okay, but wait, let me play devil's advocate here for a second. Even if the terms are fragile, a pause in conflict does stabilize global supply chains and energy markets, at least temporarily. Doesn't news like that inherently drive the market up?
You'd think so, yeah?
Because people feel safer, so they buy risk assets. It makes logical sense.
That is the assumption most people operate under, sure. But it brings us to one of Simon's core philosophies as a professional trader. The mantra is, and this is key, news doesn't make the market develops the news.
Okay, I am going to need you to elaborate on that, because that almost sounds, I don't know, conspiratorial. Like, if a literal war breaks out or stops, you are telling me the market was just going to do what it was going to do anyway based on a chart.
I know how it sounds, but it isn't a conspiracy at all. It's about liquidity and structural market cycles. The market acts much more like a living organism. It moves in rhythmic patterns, it inhales, absorbing capital, and it exhales, distributing capital.
Okay, so a breathing market.
Right. And Simon's analysis showed that the technical structure of Bitcoin was already pointing toward a final fifth wave downward.
Oh, for those tracking Elliott wave theory, that fifth wave is the final exhaustion phase of a trend, correct?
Precisely. The market structurally needed to breathe out. It needed to drop lower to find fresh liquidity.
Ah, I see.
So the sudden news of a ceasefire simply provided the emotional justification for retail traders to provide that liquidity. The technical structure was already unfolding, right? The headline just arrived right on time for human beings to attach a narrative to the math.
Because we seek cause and effect. We need a story to make sense of the red and green candles.
Exactly. High-frequency trading algorithms don't read a ceasefire headline and feel relief. They don't have emotions. They just read the sudden influx of emotional retail buyers and view it as a perfect opportunity to sell into that strength.
Man, that is fascinating. So if the market breathes rhythmically and these macro inhales and exhales take months or even years to play out, what happens to the retail trader who is reacting to a new breaking headline every 5 minutes?
Well, to keep the analogy going, they start hyperventilating.
Yeah, that makes sense.
They literally lose the cognitive ability to make long-term rational decisions. Every headline is a gasp for air or a panic attack. And when you trade in a state of hyperventilation, your prefrontal cortex, the logical, calculating part of your brain, just shuts down.
And the amygdala takes over.
Exactly. You operate entirely in fight or flight mode. A professional, by contrast, detaches from the news cycle entirely. By tracking the broader breathing patterns of the market, the professional just watches the retail herd hyperventilate, knowing full well where the underlying structural currents are inevitably pulling the price.
So if retail traders are hyperventilating and making emotional mistakes, at what point does the underlying math just force them out of the game entirely? I mean, regardless of how much they hope the price recovers, eventually the oxygen runs out, right?
Yeah, it does. And that phenomenon is exactly what Simon refers to as the exchange of hands zone.
The exchange of hands. I like that phrasing.
It's very accurate. Macro market bottoms are not random price targets. They are highly specific psychological and financial breaking points. We saw this exact mechanic play out during the 2018 bear market when Bitcoin dropped from $6,000 down to $3,000.
Oh man, that was brutal.
It was. And we saw it again in 2022 when the FTX collapse drove the price down to $15,000.
So what is actually happening mechanically during an exchange of hands? Like what's going on behind the scenes?
Maximum financial pain. It is the mathematical threshold where retail traders, institutional funds, and even industrial Bitcoin miners simply run out of collateral.
They just hit a wall.
Right. They hold on, deeply underwater, paying high funding rates or taking out loans to cover their positions until they simply can't anymore. They are forcibly liquidated or they capitulate because their emotional endurance breaks and they sell at the absolute bottom.
And on the other side of that transaction, who's buying?
The patient, calculating smart money. The institutional whales who have been sitting in cash, devoid of emotion, just waiting to absorb all of that panic selling pressure at a steep discount.
What?
And based on the current structural waves, Simon is predicting the next major exchange of hands zone will occur in 2026, specifically localized between the $55,000 and $34,000 price levels.
The underlying data supporting a drop to that zone is intense, honestly. The pressure cooker is already whistling, particularly when you look at the industrial side of the network.
Oh, absolutely. The miners.
Yes, let's look at the miners. Simon noted that the electrical cost to mine a single Bitcoin right now is hovering around $47,000.
And that metric is a vital structural floor. If the market price of Bitcoin drops below that $47,000 mark, an entire sector of smaller, overleveraged miners are suddenly operating at a daily net loss.
They're paying to keep the lights on with no profit.
Exactly. Their older ASIC mining rigs literally cost more in electricity to run than the Bitcoin they generate is worth. They start bleeding cash just to keep their facilities powered.
And we are not just talking about hobbyists in a basement here. The analysis points out that major publicly traded companies like Riot are already systematically selling off their Bitcoin reserves at a loss.
Which is a profound structural warning. When the very entities that secure the global network are forced to liquidate their holdings just to cover utility bills and operational overhead, it adds immense continuous selling pressure to the market.
It becomes a doom loop.
A self-fulfilling cycle, yeah. They sell to survive, which drives the price lower, which forces more miners to sell.
But the vulnerability goes much higher up the food chain than just the miners. Look at the corporate institutional side. Let's talk about Michael Saylor and MicroStrategy.
Yeah, the math here is wild.
Simon brought it up, and it is honestly staggering to conceptualize. MicroStrategy is currently sitting on $14 billion in unrealized losses. $14 billion.
Let that sink in.
And to back up that massive underwater position, they only have roughly $2.25 billion in cash on hand.
Yeah, that is an incredibly precarious debt-to-equity vulnerability. If the price of Bitcoin continues to cascade down toward that $44,000 level, you have to look at the mechanics of corporate solvency.
Right. They can't just diamond hand forever if the math doesn't work.
Exactly. A methodology built on continuous leverage can only sustain so much localized drawdown before shareholders' panic or debt covenants are actually tested. If an institution holding that much supply is ever forced into any level of capitulation, the resulting sell wall would just be an avalanche.
Okay, here's where it gets really interesting. Let's tie this all together. We have hyperventilating retail traders buying on news headlines. We have industrial miners bleeding cash. We have highly leveraged institutions sitting on billions in unrealized losses. And Simon points out a very specific zone where the market is currently setting a trap.
This $65,000 liquidation cluster.
Yes. So what is a liquidation cluster for the listener who might be new to that term?
It is essentially a massive concentration of over-leveraged stop losses and liquidation prices. Think of it as a giant collective pile of retail trader anxiety sitting at exactly $65,000.
That's a great way to put it.
Yeah, these are traders who bought in late, got greedy, heavily leveraged their long positions, and then set their safety nets right at that line.
And this is where I want to move away from the cliche metaphors we always hear. We often hear people describe the market as predator hunting a herd, but it really acts more like a black hole, doesn't it? It is just pure physics and gravity.
That is a much more accurate way to look at it, yeah. The market isn't evil, it's just a mechanism seeking liquidity. When enough people place their stop-loss orders in the exact same spot, it creates this massive gravitational pull.
Because market makers need counterparties, right?
Exactly. The entities providing the actual liquidity to the exchanges need counterparties to fill their large orders.
Mm.
If a whale wants to sell a massive amount of Bitcoin, they need thousands of buyers to absorb it. That $65,000 cluster is a magnet because it represents guaranteed automated buying and selling volume once the price crosses that threshold.
Which leads us to a highly technical observation Simon made. He pointed to a double positive order book spread to prove this trap is being set.
Yes, the order book data is crucial here.
Wait, hold on. I need to stop you there because for those of us who aren't glued to level 2 trading data all day long, what does a double positive order book spread actually mean mechanically? How does that physically trap a bullish trader?
It's a really great question. So when you look at an order book, you see the bids, which are buy orders, and the asks, which are sell orders. A highly positive order book spread means there is significantly more resting buy liquidity than sell liquidity.
Okay, so a lot of buy orders just sitting there.
Right. So a retail trader looks at the book and sees a massive wall of buy orders stacked up below the current price. Their behavioral bias tells them, look at all that support. The price can't possibly fall through all those buyers. It's totally safe to go long.
They see a safety net.
Yes. But what market makers actually see is exit liquidity. The market makers placed those artificial buy walls there intentionally. It's a tactic called spoofing or layering.
Wow, so it's an illusion.
Totally. They create the illusion of safety to convince retail traders to buy into the market at a high price. Once retail has taken the bait and bought in, the market makers yank their fake buy orders, the floor instantly vanishes, and the price gets sucked straight down into that $65,000 liquidation cluster.
For the black hole.
Yep. The retail traders are trapped, their stop losses are triggered, and their capital is basically transferred directly to the professionals.
Man. So if the market mechanics are actively designed to create illusions and trap liquidity, how do you even survive? This brings us to the core ethos of MyCryptoParadise. It requires a complete mindset shift from a gambler to a professional.
Absolutely. A gambler makes a prediction based on a single variable. They look at a news headline or maybe a single chart indicator, they form a bias, and they just go all in.
Hoping for the best.
Right. They expect the market to obey their prediction. And by doing so, they strap themselves into this crazy biochemical roller coaster. Winning delivers a massive dopamine hit, but losing triggers absolute devastation. As Simon points out, trading for dopamine is a fundamentally fatal approach to wealth management.
Contrast that with Simon's actual historical moves. No, wait, the data in Simon's analysis shows he distributed his holdings at $121,000 and the top at $19,000. I have to admit some confusion here.
I know, the numbers sound weird at first.
Yeah, how is $19,000 the top when $121,000 is infinitely higher and Bitcoin itself hasn't even hit $121,000 yet? That makes no chronological sense to me.
It sounds contradictory until you understand how a professional manages a multi-asset, multi-cycle portfolio. See, a gambler thinks only in terms of the current daily price of one asset. A professional scales across different market paradigms.
Okay, break that down for me.
So the $19,000 figure refers to Simon perfectly identifying and exiting at the absolute peak of the 2017 macro cycle, protecting his capital before the multi-year crypto winter set in.
Right, the 2017 top. That makes sense.
And the $121,000 figure is a combined portfolio distribution metric he utilized across various high-cap crypto assets when weighted against localized market tops. It's not about calling a single universal dollar price for Bitcoin. It's about recognizing when the cumulative liquidity in the market has reached a distribution phase.
Ah,
Yeah.
okay. So it is about scaling out of exposure when the structural wave dictates it, rather than just guessing a magic top number for one coin.
Exactly. Professional trading is not about obsessing over when to click the long or short button. It's about actively managing portfolio exposure based on constantly recalculating mathematical probabilities.
It's an ongoing process.
204.7. A professional like Simon is monitoring the market, constantly pulling in macroeconomic data, on-chain analytics, minor hash rates, technical structures, and he's constantly adjusting the statistical probability of various outcomes.
Which means you never just have one plan.
Never. You construct a plan A, a plan B, a plan C, and ideally contingency models all the way through a plan E. A professional trader runs rigorous mental and mathematical simulations of the absolute worst-case scenario.
So they're never surprised.
Right. If the market flash crashes 40% tomorrow morning, a professional has already structured their delta exposure and collateral so that their capital not only survives the drawdown, but is positioned to automatically buy the heavily discounted assets.
But the human brain inherently hates that approach, right? Our biology demands certainty, not complex probabilities. Which leads me to this fascinating behavioral trap Simon warned about, the RSI bias.
Well, this is a big one.
We see this constantly. Retail traders look at an indicator like the relative strength index, the RSI, they see it flash oversold, and their bias tells them it's an instant buy signal. They blindly hit buy, assuming it is a structural bottom. So what does this all mean? Why is that specific bias so dangerous?
It's dangerous because we are pattern-seeking machines, and we completely misunderstand the mechanics of the tools we use. The RSI measures momentum. It measures the velocity of a price change.
Okay.
So when it hits oversold, retail traders assume price must immediately reverse and go up. But mechanically, an asset can enter oversold territory and just stay there.
Wait, it can just ride the bottom of the indicator?
Exactly. The
What?
momentum of the drop is merely stabilized, but the price can continue to bleed lower and lower for weeks.
So the trader buys the dip because the indicator gave them a green light, and then they just get slowly dragged down into the $44,000 abyss anyway.
Yes, it's brutal. But typical crypto groups, especially those chaotic ones found on social media, promote this exact kind of impulsive, indicator-chasing behavior. Simon noted that these groups routinely promote strategies with objectively terrible risk-to-reward ratios.
Like what?
They'll advise traders to risk 9% of their total portfolio capital just to chase a 4% short-term gain.
Let's look at the math on that. Risking 9 to make 4, that is a totally inverted risk profile.
It has negative expected value. Over a long enough timeline, it mathematically guarantees you will lose your entire portfolio.
Because you have to be right over twice as often just to break even.
Exactly. You might get lucky on the first 2 trades, which is actually the worst thing that can happen because it reinforces the bad habit with a huge dopamine hit. But eventually, the law of averages catches up. The market corrects, and that 9% risk wipes out a month of gains in a single afternoon.
Which brings us back to the mission of this deep dive and why the Paradise family approaches the market the way we do. We are pulling back the curtain on the illusion of geopolitical news triggers. We understand the gravitational pull of those $65,000 liquidation clusters, and we can clearly see the underlying structural math pointing toward that brutal $44,000 exchange of hands zone.
And having this analytical framework gives you a distinct measurable edge. When you understand how the retail herd thinks and how the market makers manipulate order books to trap them, you no longer have to participate in their panic.
You can just step aside.
Yeah, preserve your capital and operate with calculated clarity. To really cement this framework, I want to read Simon's exact professional mantra. This is the psychological baseline you need to adopt before you execute a single trade.
Let's hear it.
I think in probabilities, not emotions, and I remain calm and disciplined in every market condition. I follow my trading system with precision and patience, waiting only for high probability setups. I respect risk management and protect my capital above all else. Losses are feedback that sharpen my strategy, and wins are the result of disciplined execution.
Losses are feedback. That completely reframes the entire mechanical experience of interacting with financial markets.
It really does.
It takes the human ego completely out of the equation. A loss is no longer a personal failure. It is just a data point to refine the next probability matrix.
It completely removes the psychological sting. You transition from being a victim of the market's gravity to being a student of its mechanics.
So to everyone listening right now, as you evaluate your own positions in the market today, I want to leave you with a final thought to mull over.
It's a good one.
If a true data-driven professional views a financial loss merely as neutral feedback, what is your current portfolio telling you about your own hidden behavioral biases right now? Are you calmly and patiently managing your exposure, waiting on the sidelines for the great exchange of hands? Or if you strip away the ego and are brutally honest with yourself, are you unknowingly part of the herd? Are you hyperventilating at the latest news headline, sitting on a negative risk-to-reward ratio, just waiting to get pulled into the $65,000 liquidation cluster?
It is the single most important mechanical question you can ask yourself today.
Thank you for joining us on this MyCryptoParadise deep dive. Remember, the market has gravity, but you control your exposure to it. Trade safe, protect your mindset, stay disciplined, and we will see you next time.